This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the next 60 minutes, we'll run through business news stories you need to know about from Africa and beyond. But first, a quick run through the markets for you. So the first week of December, pretty good for some markets. South African equities have been rising for 4 days in a row. They hit a 20-month high today. That's extended year-to-date gains on the all-share of the JSE to 4%. Nigeria's main index closed nearly 0.5% higher today, adding to that late Q4 rally, raising the index by over 30% so far this year. Now, with respect to American equities, the Dow Jones was at 30,131.56 points at 16:15 GMT, bringing it about 5.6% higher on a year-to-date basis. That is the highest point the market has hit all year. The Nasdaq Composite not any different, 12,422.64 points, 38% higher on a year-to-date basis. Here's what's coming up tonight. South Africa plans to sell a stake in its national carrier as it looks to raise some $400 million for its turnaround plans. South Sudan bags its first bailout from the International Monetary Fund. And leaders of OPEC Plus agree on a deal to increase crude production marginally come January. Details on those stories and more are in the pipeline for you tonight. But let's start with our lead story from South Africa. The country has announced plans to sell a stake in the national airline, South African Airways. Now, the airline essentially is looking to raise roughly $400 million. The funds will then be used to recapitalize the reformed SAA. Now, the government hopes that some of SAA's lucrative routes and valuable landing slots like the one it currently holds at London's Heathrow Airport will attract interest from potential investors. Furthermore, the South African government is in talks with Fairfax Africa Holdings Corporation about buying a stake in the airline. SAA has been unprofitable for the better part of a decade. It's been surviving on state bailouts and government debt guarantees, and it was placed under administration a year ago. Still in South Africa, the South African ABSA Purchasing Managers Index fell to 52.6 points in November from 60.9 points recorded in the month of October. And that drop suggests that the manufacturing sector's recovery is already starting to lose steam. Here's Angela Coppola with the details.
The decline comes after 3 consecutive upward moves and brings the index to the lowest level since July.
We've seen an improvement in quarter 2 and quarter 3 almost across the board, and also the quarter 3 figures almost back to where we were last year. It's about 2.5% down. But taking into account that last year was also not a bumper year for manufacturing, it was a pretty dismal year. It's not necessarily, saying that they are out of the woods.
It's more around the easing of the production trends in terms of decline. Just recently, the latest figures released in September, even October, show that there's an easing in terms of decline from the large decline which we experienced of negative 25%.
The manufacturing sector is diverse, with uneven recovery in the motor vehicles and metal sectors compared to food manufacturing.
It's more or less what we expected. A lot of people spending money on groceries and so on whilst they've been staying at home. And that trend is still continuing a little bit in the last 2 quarters of this year.
There were some sectors that rebounded very quickly to the pandemic. Construction building materials sales during the height of the lockdown in April were just 1 billion rand.
Now, you're talking about the figures of just above 10 billion in terms of monthly sales with regard to the construction material. So that's showing that there's some improvement in terms of the trend with regard to the demand in the sector.
The sales volumes in the metals sector have also rebounded since April.
We've seen a dip of 18 billion in April. Moving now into September, the figure is now almost close to 46 billion in terms of sales. So some element of encouragement.
The made-for-export motor vehicle industry remains under pressure, especially to the United Kingdom.
That's a concern to me because I think the UK economy will probably come out of this looking worse than we do. In terms of the size of the contraction. Having gone into a second severe, very hard lockdown now.
The immediate future for the manufacturing sector doesn't look that bright, and it's going to probably take between 2 and 3 years before everybody's back up to speed again. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
Now, the growing threat of a second wave of COVID-19 infections is putting quite a bit of strain on economies around the world. In South Africa, certain towns and cities have already been declared as hotspots. Curfews are back in place in those particular areas. President Cyril Ramaphosa has warned that the lockdown level will be increased if the situation does get worse. South Africans collectively have been hit pretty hard by the COVID-19 pandemic. Thousands of people have lost their jobs. Many have had to shut down their businesses. The banking sector is now starting to feel the pain. Here's CGTN's Sumitra Naidu with this report from South Africa.
The banking sector is reeling from the impact of COVID-19. Big players like Absa reported a 40% drop in its yearly earnings. Standard Bank reported a 20% fall, matched by Nedbank. And First Rand is expecting a 25% drop in its earnings this year. Economists, however, believe that the South African financial sector has shown remarkable resilience.
The South African financial system, and particularly the banks, are very, very well managed. And I think thanks to the South African Reserve Bank. In fact, one can even argue that the South African banks are too well managed. But the reality is that the African economy is going through a very, very deep depression. And inevitably what is going to happen, many businesses are closing down, with the banks taking a knock in the process as well.
The Reserve Bank has been commended for its efforts to manage the risks for both lenders and consumers. The central bank lowered rates 5 times this year, providing relief to consumers. But experts are worried that the health of consumers remains the biggest risk.
I think that the banks are going through a tough time. They've lost a lot of revenue during lockdown. And also because of the payment holidays that they gave out. Some of the smaller banks have already started retrenching people. And I mean, that is indicative of the fact that they have lost a lot of income.
Combined earnings in the banking sector fell 65.5% in the first half of this year compared with the same period last year, mostly as a result of bad debt.
Courts only opened recently for these kind of collection actions, and that also restricted the banks in collecting their outstanding money. And we're only seeing that starting to pick up now. And the reality is, without them collecting their money, there's no revenue. And there's just so many people who are defaulting.
South Africa's banking sector managed to get through this crisis, but not totally unscathed. Some of the banks are quietly retrenching staff, and bad debts are rising as consumers continue to buckle under pressure in a weak economy. The real crisis may still be on the way. Sumitra Naidu, CGTN, Johannesburg, South Africa.
The second Egypt Economic Summit is taking place in Cairo. The conference discussed the performance of the government during the COVID-19 pandemic, but also importantly, what lies ahead in 2021. CGTN's Yasser Hakim has more.
The gathering of experts, officials and CEOs has been analyzing the economy and opportunities arising from the pandemic era. The investment sector was in the forefront of discussions.
We have shown the investors our vision and information about the economic and investment zones, what has been achieved so far and the plans for the future. It was important to lay our strategy here. We want to improve the investment climate, raise the quality of infrastructure and readiness to receive businesses, and provide more incentives for investors.
Foreign investments saw an 11% increase year-on-year, yet it's still short of the targets set by the government due to the fallout from the COVID-19. Apart from the investment and financial sectors, there's been extensive discussions on the telecom sector and the real estate and how they were affected by the coronavirus in 2020. The government's financial support has pushed these industries forward, which helped sustain the economy during tough times.
مساندة القطاعات المتضررة.
We supported the ailing sectors through easing financial constraints and providing funds, loans and grants, especially to the tourism, hospitality, travel and services sectors, as well as small and medium enterprises. Meanwhile, there were sectors that managed to adapt to the crisis and slowly rebound. They are agriculture, telecom and IT sectors, the medical sector and construction.
Experts also highlighted the North African country's economic plans post-COVID-19 pandemic.
The government will continue its infrastructure projects and the mega projects such as building new cities and the new administrative capital. This will reduce unemployment rates further. Government will also continue to support the private sector and alleviate any hurdles so that they can invest more in the future.
The Economic Summit has commended the positive impact of the country's financial and economic policies amidst the recession-hit period. Yasser Hakim for CGTN, Cairo.
Right, then a quick run through some company news. Let's start in mining. Africa's largest iron ore producer, Kumba Iron Ore, is targeting an output of anywhere between 40 to 41 million tonnes for the next 3 years after this pandemic disrupted operations at its two mines. It dropped its forecast for 2021 by 2 million tonnes. Kumba, of course, is majority owned by Anglo American, the diversified London-listed resources company. It pegged its sales for this year 39 million tonnes. That's the midpoint of its full-year guidance. In East Africa, Airtel Kenya signed a 3-year deal with the telecommunications equipment maker Nokia for a revamp of its network to include deploying 5th-generation mobile data services. Airtel says the deployment of 5G networks will help it capitalize on growing mobile data use in the country and essentially put it on par with the race with Safaricom, which will be the inaugural operator to offer those super-fast speeds in Kenya. Heineken will start brewing its signature beer in the Democratic Republic of Congo through an $11 billion investment in its Bralima, South Africa unit, helping to cut the price of the beverage in the country by at least 35%. That 5-year investment will reduce the price of a Heineken to around 77 US cents from $1.17 at the moment. The Kinshasa-based company will help produce reusable bottles locally at its Boutellerie do Kinshasa Sal facility. And the budget carrier Ryanair has ordered 75 additional Boeing 737 MAX jets at a list price of $9 billion. Now, that deal essentially does through a commercial lifeline to the embattled US aircraft manufacturer after regulators lifted a 20-month safety ban. The order from the Irish carrier, which is Europe's biggest low-cost airline and one of Boeing's most important clients, is the largest for the jet since 2018, before 2 fatal crashes led to the grounding of the 737 MAX. Boeing shares responded positively. They're up over 5% on the news. That's a run through your company headlines. You're watching Global Business Africa. We're 15 minutes into the hour. There's plenty more coming up, including this. We'll take a look at how Kenya's tax hikes come January are going to be affecting the manufacturing sector shortly. We'll also have the details of South Sudan's first ever bailout from the International Monetary Fund.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN. See the difference. Welcome back to the program. Now, in 3 weeks' time, authorities here in Kenya will not only remove tax cuts that were put in place to cope with the COVID-19 pandemic, but the government will also be introducing 2 new taxes. From the 1st of January, Kenyan firms will have to contend with a digital service tax that applies at a rate of 1.5% on the value of the transaction. The objective there is to raise revenue from firms which are not necessarily domiciled in Kenya, think of Amazon for instance, but which provide services to clients in the country. Businesses will also have to contend with a minimum tax. Now, that's going to be levied at a rate of 1%. It applies to companies whose annual turnover is over $454,000. It's roughly 50 million Kenyan shillings. Now, ostensibly, that tax is aimed at perennially loss-making firms. But as you're going to see shortly, it essentially is a bit of a sledgehammer. It applies to a lot more different companies. Now, neither the Kenya Revenue Authority nor the Finance Ministry to date has provided estimates on how much they expect to raise through the digital service tax or the minimum tax. But the Finance Ministry does estimate that the 500 basis point cut it made in personal and corporate income tax and a 200 basis point cut in the value-added tax rate punched a near $600 million hole in its revenue forecast for the fiscal year that will end in June. So then, if you happen to be running a business here in Kenya, what does the first half of 2021 look like with this barrage of tax hikes coming your way? Let's find out. Mushai Kanyuka is the chairman of the Kenyan Association of Manufacturers. He joins us now live on the program. Thank you for your time this evening, sir. It's good to see you on the program. So let's start with a broad overview of the minimum tax. Takes effect from the 1st of January. I believe the first payment is due on the 20th of February. How will it affect the bulk of your members?
Well, actually, thanks, Ramah, for having us on. The first tax would be due on the 20th of April. That's when you'd be paying your installment taxes. But I think the biggest challenge is that how it's worded currently. It's still not clear, and we're all waiting for some sort of direction from KRA or the ministry, that's the Treasury, to tell us what the tax would be. I think it's going to be a huge impact, and especially there are 4 categories of businesses it's going to be very difficult for. One is new businesses. If you have the misfortune of starting your business anytime now, you'll be paying taxes, 3 months into your business, just opening your business. So that will be a big challenge for you. And then, of course, there's the loss-making business. And we do know that post-COVID, and as we are still going through the COVID pandemic, there's a lot of businesses that are making losses, which are genuine accounting losses, just given the consequences of the pandemic. And then thirdly, there are the low margin businesses, and we know a lot of them, especially in distribution. And those are actually the biggest concern for manufacturers because they are our distributors of goods. They're operating on gross margins of 4%, 5%, 6%. If they have to pay a tax of 1% before they've considered any of their costs, they are really going to be in a difficult position. And finally, people who have been given tax incentives. And this is a little bit confusing, I guess, because the government has given you an incentive, like capital allowances, therefore reducing your tax. You don't have any tax to pay. So it is, if they're coming back to ask for tax, probably the thing they should have done is to remove the incentive rather than create a whole new tax that covers everybody.
Indeed. Let me just go back to something that you said at the very start. And this is the thing that I find really surprising about this tax. Is introduced back in July, essentially, with the Finance Bill of 2020. We're now 3 weeks to its implementation, and the Tax Revenue Agency still has not reached out to you as manufacturers and said, this is how this is going to work. I mean, that's a shocking level of incompetence.
Well, I think there was a challenge in it because actually what they did in the wording of the bill, and I'm not sure where the error came from, but it does have a fundamental error. And in fact, it's a challenge in how it's going to be implemented. So although it meant to say that if your installment tax is lower, you'd have to pay the minimum tax, the law actually as written says that, the reverse, that you wouldn't have to pay if your installment is lower than your minimum tax. So whatever guidelines the KRA issues, they will not be matching with the law. And the guidelines KRA issues cannot be above the law. So we were expecting some sort of amendment on that clause. And we understand there is going to be an amendment because this morning, the Treasury just said they're going to be changing some of the tax benefits that we had. So we expect within that law, there might be some amendment trying to deal with this issue. So it's actually not enforceable as currently worded. And we are trying to convince government that probably we need to suspend it because it's also the timing of it at this time. We're coming out of a pandemic. A lot of business is struggling. It's really not the time for new taxes.
Indeed. The minimum tax was proposed, as I mentioned, as part of that 2020 finance bill. And I know a lot of industry players, yourselves, ISPAC, the Institute of Certified Public Accountants, they all pushed back against it. But when you pushed back and you told Treasury, look, this is a bad idea, what feedback did you get?
So the Treasury has maybe two main points of attack. One is they are talking about there are companies that have been trading for a long time. They keep showing losses and no taxes. They're not paying any taxes. So, okay, that's one pocket of guys. Then, of course, they're complaining about the people who are taking advantage of capital allowances and so on to have tax-free, positions at the end of the year. They have tax-free accounts.
But even with those capital allowances, that's not entirely, 100% getting off. You're not paying any taxes. You're still paying everything else on VAT. You're still paying income taxes on for your employees and so on. You're not scot-free, for lack of a better word.
You're not scot-free, and also you're within the law. So they have provided this for you. So what we are saying is, if those are your targets, then change the law and reduce and we're not encouraging them to do it. I think the allowances are there for a reason, but if you want to limit the allowances, then limit the allowances. You don't need a tax that covers everybody else just because of those allowances. On the people who are, say, miscreants, they're tax avoiding and so on, introducing a new tax does not make them pay taxes. They are called, they are perpetual, forever avoiding taxes. So what tends to happen is when we introduce a new tax, you then catch all the legitimate businesses who've been trying to pay their taxes, and you catch them into this net. Whereas the people who are not paying their taxes, they're not going to pay just because we've created a new tax. They are going to find new ways of avoiding it. So we need probably to strengthen the revenue authority in terms of their audit and their follow-up ability. That's how you're going to get those companies to pay taxes, rather than creating new laws that just make it difficult for everybody else.
Indeed. Last week, the energy regulator told me that Kenya Power, the electricity distributor, is actually looking for an exemption formally from the minimum tax. But with respect to the manufacturing sector, do you have any estimates on how this minimum tax, because it's going to be implemented either way from the 1st of January, do you have any estimates on how this will affect investments and jobs and the number of operational companies that are still in the manufacturing space?
Well, we know it's going to have an impact because we did some surveys on our members, and we're trying to do them every quarter or so to check what the impact of COVID has been on them. And when we ask them, you find 80% of our members have had cash flow challenges. When you go to the smaller businesses, 90% of them are having cash flow challenges just based on this. A lot of people are operating below capacity. More than half of our members are below half their capacity in terms of what their production is. So cash flow is a real issue. And what's going to happen if they have to choose whether to pay government first or pay their employees, sometimes their financiers. In cases where people are actually making losses, it means they're digging into their equity or having to borrow just to be able to survive. Now, if they're going to have to borrow to pay taxes, a lot of business people are going to opt not to do those businesses. You have to scale down your businesses, reduce your employees, again, creating a problem. And if we think about, post-pandemic and this economic crisis we have, what you want to keep going is incomes so that there is some demand. So if we're now affecting jobs, we're going to be affecting, the aggregate demand for the country. Then we're still, I think, where we're going to have challenges, and I mentioned the small and medium companies, is that the risk of going underground out of the tax system entirely is just enhanced. Because always, if the cost of paying tax becomes higher than the cost of avoiding it, or then you just decide to avoid it because it's cheaper to avoid the tax. Either close your business, go dark, and try and survive that way, which is then going to be counterproductive for the government's goal, because all this is all about trying to raise the revenue. And if we keep businesses closing, jobs being lost, or people going underground, revenue goes down. And we enter a downward spiral that isn't helpful for the country.
Indeed. Let's see how this all plays out. Mushak Nyang from the Kenya Association of Manufacturers. Thank you very much for your time this evening. Now, let's turn our attention to South Sudan. The country secured a $52 million facility from the International Monetary Fund to address a very urgent balance of payments crisis. Now, this is the country's first ever loan since it joined the Washington-based lender back in 2012. South Sudan's economy is forecast to contract by at least 3.5% in the fiscal year that ends next June. That's about 10 percentage points below its pre-pandemic baseline. From Juba, here's CGTN's Patrick Oyet.
South Sudan's finance ministry says the $52.3 million loan is the country's first from International Monetary Fund since joining the financial institution in 2012. For half a year, civil servants in South Sudan have not received their salaries. The government says part of the loan from the IMF will be used to pay those arrears. But despite the loan, it is asking for more financial support from international donors.
We acknowledge that these efforts by the government are inadequate to address the stark challenges facing us today. Government cannot do it alone. All the stakeholders must come together to contribute and collaborate to tackle the issues.
The IMF says it approved the loan known as Rapid Credit Facility to mitigate challenges caused by the coronavirus pandemic in South Sudan. Flooding in parts of the country, locust invasion, and a fall in global oil prices have exacerbated South Sudan's economic situation. The IMF says it granted South Sudan the loan after the country's central bank implemented IMF's recommendations to record all oil exports and transactions under the Transitional Financial Agreement. The Bank of South Sudan says the loan is only a short-term solution to the country's economic challenges.
The main problem of our economy is issue of production. And of course, that's long-term. It's medium to long-term. We need to be producing, because if you don't produce, really, it's very difficult for you to stop inflation, especially if we take South Sudan as a small open economy like us, depending mostly on importing so many things.
South Sudan's government says the economy is projected to contract by 3.6% in the financial year 2020-2021 due to the pandemic and effects of years of conflict. The United Nations says it is concerned that the poor economic performance will set back the implementation of the country's 2018 peace deal.
The government's capacity to deliver peace dividends that may indeed put at risk the revitalized agreement on the resolution of conflict in the Republic of South Sudan. And this is of enormous concern to all of us as your partners.
In August, President Salva Kiir formed an economic crisis management committee to try and come up with a way out of the current economic challenges. But inflation is continuing to rise and prices of basic goods are now beyond the reach of many. Patrick Oyet, CGTN, Juba, South Sudan.
On to the biggest story, really, of 2020. Johns Hopkins University data says that the world's case count for COVID-19 stands at 65.3 million. 1.5 million people have died from COVID so far this year. These are staggering numbers, and they come as world leaders meet virtually for day 2 of a special session at the United Nations on how to address this global pandemic. At the General Assembly in New York, the UN chief, Antonio Guterres, says that the pandemic has created long-term problems.
A vaccine cannot undo damage that will stretch across years, even decades to come. Extreme poverty is rising. The threat of famine looms. We face the biggest global recession in 8 decades. And these intergenerational impacts are not due to COVID-19 alone. They are the result of long-term fragilities, inequalities and injustices that have been exposed by the pandemic.
The UN Secretary General also criticized several countries, without mentioning any specific names, for ignoring scientific guidance from the World Health Organization. Now, the UN says the special session is a chance to make sure that vulnerable communities around the world do get access to vaccines eventually. The Chinese Foreign Minister Wang Yi stressed the need for equal access.
The Phase 3 trials of China's coronavirus vaccines are at full speed. Once they are completed, we'll move on to production and distribution immediately. China treated the vaccine as a product for public health. We'll prioritize the distribution to developing countries as one of China's contributions to a shared future of health for mankind.
Now, if the COVID-19 pandemic has been the big story of 2020, developing a vaccine against it has been one of the key subsets of that story. So where do we stand on rolling out a vaccine, or vaccines in this case, against the coronavirus? Here's a look.
The first batch of the Pfizer-BioNTech vaccine has arrived in the UK. It's expected to be rolled out next week. The US top infectious disease expert Dr. Anthony Fauci earlier criticized the UK for its hasty approval, but later apologized. Canada could also approve the vaccine within the next week. But Pfizer has slashed its 2020 production target from 100 million to 50 million doses. It cites supply chain challenges as the reason. Another promising vaccine is one developed by US drug maker Moderna. It's asking American and European authorities for emergency approval. The first batch could be available in the US by year's end. Moderna expects to offer between 100 million and 125 million doses available globally in the first quarter of 2021. Russia is the first country in the world to approve coronavirus vaccines, but its 2 vaccines were registered before final stage trials were completed. On Wednesday, officials said more than 2 million doses of the Sputnik V vaccine will be available within the next few days. Meanwhile, 5 Chinese vaccines are undergoing final stage clinical trials in over 10 countries. Chinese firm Sinovac is cooperating with the Brazilian state of Sao Paulo on the CoronaVac vaccine. The state has received over 1 million doses. Sinovac is expected to publish efficacy results by December 15th. Li Jingyi, CGTN.
Authorities in Tunisia are seeking to boost e-commerce and reduce the use of physical cash. The North African economy is looking to have over 300,000 retailers route their transactions to a national electronic payment system. The value of e-commerce transactions over there rose to $80 million last year. From Tunis, here's CGTN's Adnan Chouachi.
Tunisian Ministry of Commerce officials have said they are embarking on plans to digitize commercial transactions and limit the use of cash. The e-commerce department says the ministry recorded 5.3 million transactions in the first 9 months of 2020. This number increased by 87% compared to the same period in 2019. The value of e-commerce transactions for both administrative services and goods reached 270 million dinars, which is around $100 million.
There's a new dynamic in the e-commerce sector since the pandemic and the health confinement. There are also too many offers on the websites and social networks. Cash on delivery is still widespread, but we aim to decash up to 90% of these operations. The state is boosting digitization and e-payment, so we are also offering the export facilitation platform Easy Export to promote exports by SMEs.
The African e-commerce giant Jumia is the leading mainstream e-commerce player in Tunisia. The company has offered new services since the outbreak of the COVID-19 pandemic in a bid to facilitate transactions and to decash payment operations.
The e-commerce in Tunisia and in Africa has a lot of challenges also, mainly the logistics challenge and the payment challenge. The payment challenge mainly because our economy is still very, very cash driven. So basically in Jumia we have a big percentage of our payment going through cash. But fortunately we launched Jumia Pay in March 2020 and we have more and more customers paying with credit cards and with electronic payment methods.
In the month of November, over 10 million people visited Jumia website to take advantage of the exceptional offers during the 3 weeks of Black Fridays. Recent statistics show that the company's customers live in all regions across the country.
Jumia Tunisia is now working since more than 5 years. We grew our number of employees to serve our customers from few people to nearly 200 people. And our customers on the other side are coming from all backgrounds. Most of them are young, but you have also family, a lot of households. People are purchasing products from a different range of categories, from electronics to groceries.
According to the Minister of Commerce, Tunisia aims to boost exports by offering incentives to thousands of exporting companies and businesses. The government will also support the retailers and private sector operators that will invest in e-commerce and offer electronic payment services. Experts assert that the growth of e-commerce in Tunisia will significantly depend on the quality and efficiency of logistics networks. Authorities in Tunis, as well as private e-tailers like Jumia, seek to boost e-commerce and to curb the use of cash. Adnan Shawashi, CGTN, Tunis.
You're watching Global Business Africa. It's 18:35 GMT. Time for a short break. Here's what's coming up. The OPEC Plus oil cartel agrees to increase crude production marginally in January. Protesting farmers in India and the government have failed to reach a deal over new agricultural laws. We'll have the details when we come back.
Taken me completely out of my depth, but at the same time it's exciting. It's new, it's different, it's a challenge.
It's really exciting.
Over the last 14 hours of rain.
I try to not let it affect me, but there are days when it does. I'm a human being, and to see patients in a hospital bed and their family members are not there, there's no one there to hold their hand, that human touch, you know?
I just hope everyone can remember that the situation is not permanent and that everything will get better eventually.
Welcome back. Let's run through some of the stories making your headlines at this hour. Starting with the UN. World leaders have been meeting over there virtually for the second day of a special session at the United Nations to address the global pandemic. At the General Assembly in New York, the UN chief, Antonio Guterres, says that the pandemic has created some long-term problems for all of us around the world. He added that the world is facing the biggest global recession in at least 8 decades. Ethiopian Special Federal Police Forces are now operating in Tigray's capital of Mekelle. The city is still seeing some protests from the civilian population. A spokesperson for Ethiopia's foreign ministry has outlined the federal police's mission in Mekelle. In the meantime, the UN says continued fighting is hindering efforts at delivering aid. Millions of people are said to be running out of both food and medicine. The UK's government has started deploying 300 troops to the country of Mali. The troops will take part in a 3-year deployment. They will join the UN mission in the West African state. The UN peacekeeping operation there is considered to be among the most dangerous missions in the world. The country has been fighting against terrorists since 2013. The British troops will be stationed in Gao, a region in northeastern Mali. And finally, political campaigns in the world's second largest cocoa producer, Ghana, have gone a little bit higher as the country is preparing to go to the polls on the 7th of December. President Nana Akufo-Addo is seeking re-election and he faces his former opponent, the former president, John Dramani Mahama. And while Ghana is believed to be a leading example of democracy in West Africa, it still grapples with issues that affect confidence and participation in the electoral process. That's a run through your headlines. On to the business of oil now. OPEC Plus have agreed to increase oil output by 500,000 barrels a day from January. The group also agreed to meet monthly thereafter to decide whether or not to further adjust outputs depending on how the global economy is performing. Now, that decision comes in the wake of days of wrangling among the oil-producing countries over whether or not to increase output early next year. After all, the pandemic did sap demand for energy this year, and it really muddled up the outlook for energy demand in 2021. OPEC members and their allies, essentially that's the plus in OPEC Plus, had made deep cuts in production last year to support prices as the pandemic sharply reduced demand for fuel.
All sides have confirmed their commitment to the declaration of cooperation and have stated and confirmed that 2 million barrels per day of production at some point need to return to the market, although it is clear, and this has also been confirmed outside, that the pace of this return should be determined by the state of the market.
We could tweak upward, we could tweak downward, and we could stay put. And it is all about addressing uncertainty. If you have an uncertain situation, you need to be attentive.
The EU chief, Charles Michel, is urging members of the bloc to remain united behind Brussels negotiators in post-Brexit trade talks. That came after France threatened to veto any deal that gives grounds to London. Michel congratulated the EU negotiator Michel Barnier on keeping member states fully appraised of his progress in talks in London. Now, the UK, as you might recall, left the European Union on the 31st of January this year, and its post-Brexit transition period comes to a close at the end of December, when it will formally leave the EU single market. Mr Barnier is engaged in intense talks in London with his UK counterpart David Frost on a trade deal that will govern cross-channel business ties from 2021. But European officials are fearful that if an accord is not found within days, there will simply be no time whatsoever for the member states or the European Parliament to ratify any agreement. In the meantime, the retail sector in the UK is set to end the year with significant losses. Both small shops and big-name luxury malls are subject to dropping sales due to a new wave of COVID-19 infections. Here's CGTN's Nawija Bakil with this report from London.
Open for business. Fabrizio Accoli's fashion store in London has been closed since early November. Like thousands of businesses, he was ordered to shut his doors as part of a nationwide lockdown.
Yeah, it's a bit struggle to stay open again because now we suffer. We are independent, and if people don't get to the shopping, it's a bit struggling.
Fabrizio says sales are down 40% so far this year, and it's a similar picture nationwide. Britain's retail sector has been battered by COVID-19. Lockdowns and restrictions have meant fewer customers and sales. The Centre for Retail Research expects shops to have lost more than $23 billion in sales this year alone.
After almost a month of closures, many businesses are keen to make up for lost time. But the pandemic has hit the UK economy harder than most major nations. And the worry for many retailers is that even though they can reopen, the damage done so far this year may force them to quickly close down for good.
It's not just small businesses feeling the heat. Luxury retailer Harrods has started its traditional Boxing Day sale almost a month early.
This has been enormously costly, the first lockdown and the second lockdown, and the lack of the international tourists for us has been hugely costly. But we've managed to pivot around that. Even during that time, we've got stronger on our web.
For many businesses, the end of a second lockdown will be welcome news, especially alongside progress on a vaccine that could see life return to normal next year. In the meantime, the focus for many retailers will be simply to survive.
Talks that started on Thursday between the Indian government ministers on one hand and farmers' unions on the other have failed to break a deadlock between the two sides. The current dispute is over laws passed earlier this year that seek to deregulate the agricultural sector. With the details on this, here's CGTN's Mohammed Abubakar.
In India's biggest farm unrest in years, tens of thousands of growers are camped outside the capital, New Delhi. They are protesting laws passed in September, seeking to rid the sector of antiquated procurement procedures.
The government will have to accept our demands, and we will only leave after they accept them. Until that time, the movement will carry on.
Farmers have been protesting the laws for nearly 2 months in Punjab and Haryana states. The situation escalated last week when tens of thousands marched to New Delhi. They clashed with police who used tear gas, water cannons and batons against them. The government claims the new laws will give farmers greater autonomy to set their own prices and sell directly to supermarket chains. However, farmers say it will leave them worse off. They are asking the government to define minimum prices for crops so that they are not exploited by big chains.
The Agriculture Minister, officials and government representatives are suggesting amendments to these bills, but we are not interested in amendments. We are hearing this for the past 2 months. We want these bills to be repealed.
On Thursday, 40 farmer leaders met senior Indian government ministers and held a long meeting to resolve the matter. The fourth round of talks, however, failed to make headway and are set to continue over the weekend. Prime Minister Narendra Modi's government has defended the new laws, saying the minimum prices for grains will continue and land belonging to farmers will also be protected. Nonetheless, the ongoing protests still pose a crucial test for the government's ability to reform India's vast agriculture sector. The industry makes up nearly 15% of the country's $2.9 trillion economy and employs around half of its 1.3 billion people. Mohammed Abubakar, CGTN.
And the world's largest maker of disposable gloves, that's Malaysia's Top Glove, has enjoyed record profits and record share prices over the course of this pandemic. But in the past few days, an outbreak of the coronavirus among its foreign workers has fueled a record rise in COVID-19 cases in the greater Kuala Lumpur area. As CGTN's Ryan Melson now reports, the Top Glove outbreak, as well as other big clusters among migrant workers, is shining a harsh spotlight on their living conditions.
Barbed wire pens in thousands of foreign workers at Top Glove's hostels outside Kuala Lumpur under Malaysia's strictest form of lockdown. The company's more than 24 factories are closing in phases to allow mass testing.
We hope that we can quickly undertake testing of 13,000 factory workers, separate and isolate the positive ones, and quarantine their close contacts.
More than 3,000 out of the 7,000 Top Glove workers screened so far tested positive. There's been another major outbreak in the capital among foreign construction workers. Housing for migrant workers here is usually crowded and haphazard, a mixture of informal hostels and squalid shacks. Activists and health experts say Malaysia is now paying the price for that.
The migrant rights NGOs have been voicing this out for 20 years. Hostels have been in very horrible conditions. It's just now that there's a pandemic, people are starting to look at it in a more serious manner.
Top Gloves say they've spent millions of dollars in recent months buying and renting new accommodation and upgrading the existing housing for their migrant workers. In May, amid worries over COVID-19, the government amended regulations to ensure better housing for migrant workers and gave employers till September to comply.
The Act allows for hefty fines if employers fail to provide satisfactory living conditions for the workers. From Thursday, we'll start the enforcement measures to make sure employers follow the regulation.
Activists are unconvinced, and they wonder if such big outbreaks can happen among documented migrants working for famous companies. What's happening among smaller companies and the estimated 2 million or more undocumented migrants in Malaysia? Ryan Meltzer, CGTN, Selangor, Malaysia.
Quick run through commodity prices. I'm going to focus on oil in this particular space. Brent crude, we spoke about this a little earlier. It's flirting with that $50 a barrel mark in today's trading session. It actually went as high as $49.86 before trending a little lower. Now, spare a thought, though, for refiners on taking on crude at these prices. And then they have to turn around and figure out who they're going to pass on those higher costs to at a time when fuel demand in big markets like the United States and in continental Europe is pretty weak. Here's what's coming up next. We'll take a look at a homegrown company in Tanzania that's leading the way in reviving the leather industry.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Welcome back. Here's a few interesting factoids for you. Tanzania is home to the second highest number of livestock in Africa. If you're wondering who's ranked at the top of that list, it happens to be Ethiopia. Now, while Tanzania does boast of a large production of hides and skins, it still imports roughly 50 million pairs of shoes every year from China and other Southeast Asian states. Only 1.2 million pairs of shoes are produced every year in Tanzania. Tonight, however, CGTN's Daniel Kijo takes up the story of one homegrown firm that's trying to meet local demand. That's his focus on Grassroots tonight.
Oiso Original Products is taking steps towards greater use of Tanzania's leather supply. The 20-year-old company makes a variety of styles of shoes, bags, and suitcases.
We work with orders. Per day I can hit 3,000 shoes. It really depends on the orders. We can even make 100,000 shoes and still deliver on time.
The company employs over 183 staff and has a youth training program with 100 trainees. Despite being the second cattle producer in Africa, the country only produces 1.2 million shoes annually. In a bid to support local producers like Oiso, President Magufuli's government has upped the import duty on second-hand leather products imported into the country from 25% to 35%.
Takwimu zinaonyesha kuwa kwa wastani kwa mwaka.
Statistics show that on average our country needs 54 million pairs of shoes annually. We also need purses, bags, belts, leather jackets and more. You can clearly see the demand for our leather products.
Majaketi ya ngozi na kadhalika.
Ministry of Livestock and Fisheries statistics show that at least 50 million pairs of shoes are imported into the country each year. The founder of Oiso Original Products, Mr. Kenneth Oiso, worked as a shoe shiner in a small stand much like this one in the streets of Dar es Salaam. His drive and ambition resulted in him owning his own factories. Now, the government says it wants to create more success stories by regulating imports of synthetic and used leather goods which compete unfairly against local leather products. Oiso's management says, despite the challenge of unfair competition from synthetic products imported, they want to expand into other markets.
We want to keep improving our products. We are at the international level, yes, but we want to go further.
The government has encouraged the use of modern tannery technology and the establishment of leather technology training and research institutes. It hopes to create a better fit between the country's cattle levels and the number of shoes produced domestically. Daniel Kijo, CGTN, Dar es Salaam.
Many companies dealing with fast-moving consumer goods in Nigeria lose millions of dollars every year just because of poor logistics and distribution networks. Now, that gap between manufacturers on one hand and retailers on the other does pose a major challenge to players in the country's informal sector. But there's a startup in the country that's deploying tech to try and solve that problem. Here's CGTN's Deja Badmus with their story.
Using technology to solve a common problem and making money in the process. That's literally what Trade Depot, a B2B e-commerce platform, is doing. Informal stores or shops like this one account for most of the retail sales in Nigeria. But there's one problem: getting their supplies from manufacturers. That's exactly where Trade Depot comes in, serving as a bridge between manufacturers and retailers using technology.
It starts with building relationships with these various suppliers and aggregating their inventory in our warehouses, right? So that we have this inventory from the different consumer goods manufacturers available, right? And then we build digital platforms for these retailers to then use and make requests for the products they want. You can simply just identify the items you want and place a request on an app, by calling a toll-free line, by chatting over WhatsApp, whatever. And then our job is to identify these items you want and get them across to you by the next day.
After taking orders from the small retailers, Trade Depot then does the delivery from this warehouse using its special delivery agents. In the case of Lagos, the delivery agents drive around the city on a daily basis, delivering supplies to retailers. The startup handles distribution for some of the biggest FMCG companies in the country and distributes to a network of over 40,000 micro-retailers who can place orders through the firm's different platforms and get their supplies.
We are in about 48,000 stores in total that we service. Our focus is to make sure that if you make a request to us, we promise you that maximum within 24 hours you get those items delivered.
It may sound simple, but it's a lot of hard work for Izukane and his team, who only started out 4 years ago. And beyond just distribution, Trade Depot also supports retailers on its platform with credit in the form of small loans.
A lot of these folks normally have no way of getting access to credit, not because they wouldn't be credit worthy, but because the structures that exist do not support access to credit for people like this, because there is no data by which you can score them, by which you can decide who gets credit or not, right? But by giving them a platform like this that allows them to build transaction histories, we now have a basis to do the scoring, right? And so based on this scoring, we can identify that actually this person qualifies for credit, and then we extend credit to them. Interestingly, we find that over 80% of the people that we give credit, this is the first time in their lives they are getting credit from any source.
While a number of startups have been pushed out of business due to the harsh effects of the COVID-19 pandemic, Trade Depot has found a way to beat the virus by launching a digital distribution channel during the nationwide lockdown.
When the lockdown resulted in the traditional distribution channels not being available or being very limited, it significantly increased the urgency for everyone, both the retailers and the manufacturers, to adopt more digital channels.
Since it launched in 2016, the startup has raised around $13 million to scale its operations. The business is growing, and Izukane and his team have their eyes set beyond the borders of Nigeria. Deji Badmos, CGTN, Lagos, Nigeria.
Run through some currencies as we wrap up the program. The Naira essentially staying steady at the levels of the latest devaluation, about 1.55%, 392 to the dollar. The Kenyan shilling 110 to the dollar as well. Some interesting conversations taking place around a parallel rate of sorts that was emerging in the market in the course of 2020. However, as far as the crypto side is concerned, Bitcoin under $19,000, down 2.6% at 1613. GMT. But remember, that's barely dented its 40% rise in the last 4 weeks. Crypto has certainly been quite the beneficiary of this year. That's it for this edition of Global Business Africa. As always, we'd like to hear your thoughts on the content you've seen on the program in the last hour. there are many ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour.